Is a credit crunch swallowing Australia's biggest property markets? Home loans plunged nearly 6% in December, but the figure everyone was jumping on was the slump of 20% in the last year, which was the worst since the global financial crisis. Home loans, of course, are considered a leading indicator of home prices, and hence the headlines today.
Exactly. Meanwhile, mortgage rates are being cut and hiked, seemingly on a whim by some of Australia's biggest lenders. So really, what do borrowers need to know, and what makes for a good loan candidate in this market? Mark Bouris, who is Executive Director at Yellow Brick Road, joins us now. Mark, thank you for being with us.
Hey, guys.
To start on these lending figures, lending falling, does that mean that house prices in capital cities automatically follows that?
Well, when they say lending figures, I think we discussed this last week, when lending figures are falling, that means there's less capital, less liquidity in the marketplace, which means, it doesn't mean that there's less inquiry, by the way.
Yep.
From my point of view, it's just less lending. That means that less people qualify. Because to me, there's been the same amount of inquiry. We've had the same amount of inquiry every month we've had for the last 10 years, just we're not approving as much. So we're down, 2 years ago, we would have lent 40% more.
Yep.
That's a lot.
It's 40% more in total amount of money.
But you're saying that's not coming from the demand side,
it's coming from the supply side. It's coming from our side.
Which is the regulators,
all the regulatory environment. Yeah. So in other words, people who did qualify before don't qualify today, or people who did qualify before for $400,000 only now qualify for $280,000, and as a result of that, house prices suffer because people can't afford to pay the same price. It's funny, only today I was talking to a guy, real estate agent, and he told me that he showed me a little terrace house. I thought I'd rush down and have a look at it. It was available for sale, and I was just looking at it. I don't want to buy it. I was looking at it from a survey point of view. He told me that this lady bought this house at the peak in late 2016. She paid $1.7 million for it. She spent $200,000 on it. She's selling it today for $1.7 million. Ooh. And it's in these suburbs. It's it's an area which is highly sought after, close to the city, beautifully done, a very beautiful terrace house. Everything you need. Don't need to do a thing. But she's dusted $200,000. So she and she wanted more. She was asking more, but the buyers are offering less. And the reason why buyers are offering less is that one, buyers are smarter. They watch the media, they read the media, they know that they're in a position to offer a lesser price. But equally, buyers don't have as much capacity.
Sure, they haven't got the money in their pocket.
And if I can lend you less, you can't automatically find the balance because you already got your deposit's already got a fixed amount that you've got.
It's strange in this environment, though, Mark. We keep on seeing these headlines about mortgage rates being hiked and cut by different lenders on different days. Can you help us understand? Because it's confusing.
Well, that's why you need a broker.
We've had that argument before.
Well, you fell into that one.
Actually, we've got just a graphic to help explain to people some of the lenders that are changing. So Macquarie's made some big changes depending on basically if you're on a variable rate or a fixed rate, which you can see on screen there. And AMP, I mean, look at some of the differences. So if you're on a variable home loan with Macquarie, that's been hiked by between points.
It's 0.6%. It's
0.06. It might be.
No, it's 0.6% because we did the same changes at Yellow Brick Road.
Okay, good.
So we've changed our rates by 0.6 at the same time Macquarie did. 0.6 and 0.16, and it depends on whether or not you're an owner-occupier or an investor.
Okay.
So the investor got the higher increase, and the owner-occupier got the lower increase.
Okay, so investor on a variable loan got the higher.
Investor on a variable loan got the 0.16, and the reason for that is when we last made our rate increases, which was July last year, and then the big banks followed us after that, they went up by a much greater amount than we went up back then. So to some extent, we're playing catch up. Yeah. If you look at our rates, all the rates, because I did this today before I came in, because I thought you might have asked me about this. All the rates are still within in owner-occupier, around between 3.81 and 3.92 or something like that. They're all within a range of about 8 basis points.
Okay. So pretty competitive.
Fairly much the same.
And we'd be able to get our heads across that if that was what were happening across the entire market. But across town, you've got AMP slashing up to 75 basis points off some products. So is it all about the type of borrower and the type of product?
Yeah, it is about the type of borrower. It's about the type of borrower, the type of product, and also where you were in that competitive pricing cycle last time round. So the last time round was July to September when changes are made outside of the Reserve Bank, I'm talking about here, and everyone started the new year by readjusting their positions. So AMP must have been out of the money, and AMP have come back. Now that's nothing to do with fixed. Fixed is a totally different environment. Every year in January and June, you have a fixed cycle. Usually lenders are chasing fixed rate product in January and June. It's a good time to get fixed rate products.
Right.
So you'll find that a lot of the lenders are reducing the fixed rates right at the moment.
Yeah, and interestingly, because we've had a lot of discussion about rate cuts, that affects those fixed rates as well, right?
Correct. Well, they're predicting where rates are going to go.
Because they want to lock you in at probably higher than what they could later on.
And they can arbitrage
rates are going to be
better
cut
than you
from
can.
Here.
So they work out, lenders, what we do is we work out, a fixed rate, lower fixed rate today compared to the variable rates. If we offer a new fixed rate, which is lower than the current variable rates, you might say, well, that looks pretty good to me. Yeah. Generally, what we're saying to you is if we fix for 2 or 3 years, we actually think the variable rate's going to go lower over the next 2 or 3 year period. Very often, it's rare that a lender loses money on a new fixed rate. You will not out-arbitrage them.
Okay, so we've talked a bit about fixed, a bit about investors. We promised to tell people the type of borrower who is going to be sitting pretty right now, the most attractive to a lender.
Owner-occupier.
Owner-occupier with a certain
below
deposit,
70, with a less than a 70% loan-to-value ratio. In other words, if it's $1 million property, they're only borrowing $700,000, or they're borrowing $350,000 if it's a $500,000 property. So lenders want to lend to prime borrowers, what they consider prime borrowers. There's like a new category sitting right up there above AAA. Because the cost of capital in relation to those, the cost of capital for the lender in relation to those particular borrowers is less, so you allocate a lot less capital. You know there's a lot less risk involved, so you're not putting into the price any provision for arrears and delinquencies. So we're looking for people less than 70% LVR, loan value ratio. We're looking for people who have a job.
70%?
Yeah, a job. This is for the very good prime stuff. Okay. A job, in other words, they're not small business owners or self-employed. They've been in a job for a period of time, so they're stable. We have all their bank statements and credit card statements, and best of all is if they bank with you. In other words, you know their stuff straight up. You know they're
tough old world out there, isn't it?
Totally.
Yeah. But people don't have too many Uber Eats and have no credit cards and all that. So
all that's, and you know they're not on every other subscription like Netflix and blah blah blah. Sure. And on top of that, what lenders like to see is that these individuals have never had default, so there's no issues around their credit reference.
And so do you think? And the other bit of news today was that the NAB, one of the big 4 banks, seemed to join this chorus of, well, the RBA doesn't look like it's going to be hiking rates. They still reckon it's going to be on hold, but there's plenty saying they'll be cut. Is this game-changing for rates for homeowners, this rate cut debate?
Well, I think so, because that's why you're seeing some fixed rates now coming off.
Yeah.
Because
so that's the direct flow-through for people, why we talk about that all the time.
Generally speaking. So, but there's one thing is for sure, if you do, we've done the analysis a million times over, variable rate always outperforms fixed rate. So over a period of time, no matter what, even if to start off, if today's a starting point and there's a fixed rate for 2 or 3 years, which is less than your current variable rate, the variable rate usually outperforms a 2 or 3 year fixed rate over time. Even though you think you're going to outperform it by getting the fixed rate, you just get peace of mind. That's all you get.
Right. Brilliant.
Mark, you've seen a lot of interest rate moves from the RBA in your time. It's been about 30 months since everybody has seen this happen. We're at 1.5% now. How many cuts come at once, do you think?
Ooh, look, Chris, I get very worried about the RBA cutting rates further, just to respond to a little bit of a GDP issue for us, or not having our inflation targets being below the targets. My gut feeling is the Reserve Bank will be very reticent to reduce interest rates, just to meet some little targets, because if they do, they're going to leave themselves no bandwidth in the event that there is a major problem. So my gut feeling is the Reserve Bank will not reduce rates. They usually reduce rates as part of a series, and they just don't do one-offs. They're not going to reduce rates as a part of a series unless there's some major reason, so some sort of shock from somewhere that they have to fix and deal with. And by the way, it doesn't necessarily follow either that you, the consumer, will get a rate reduction.
Yeah,
yes, exactly.
That's a very
decoupling happened a long time ago, 2015, 12, whenever it was. Banks decoupled themselves from the Reserve Bank. The banks might say, look, the cost of funds is still high for us because we're getting most of our money from overseas, because the overseas cost of money is running at a different direction. So, you know, US interest rates are going that way. And, you know, up to 40% of all funding in Australia is from overseas.
Mate, we always cover a lot of territory when we chat on the show, and we really appreciate it. We love it. No, it's good. I know. But
I can see you giving me the wind-up.
So worth it, though, you know?
We got the wind-up long ago, but we wanted to just ask this last few. Sorry,
exactly.
producers.
Mark Bouris, thank you very much from Yellow Brick Road. Appreciate it.